Welcome to this special video episode of Ethically Speaking, the podcast of the AICPA Professional Ethics Division. If you have questions about anything in the episode, please reach out to us at 888-777-7077, option 2, then option 3, or send us an email at ethics@aicpa.org.
I'm Tony Lee Andrews, Director of the Professional Ethics Division at the AICPA. Jeff Lewis, Professional Ethics Executive Committee member from Dixon Hughes Goodman, is joining me today as we talk about the independence considerations of implementing Financial Accounting Standards Board, FASB, Accounting Standards Codification, ASC 606, which is the new revenue recognition standard that affects all businesses that enter into contracts with customers to transfer goods or services. Jeff, thanks for joining me today.
Yeah, thanks.
You know, recently we saw a private company council poll, and it said that as of July, 52% of private companies had not yet started implementing FASB 606. And therefore, the expectation is that many firms are going to need assistance with the new standard. The changes for revenue recognition may be difficult for clients to understand and thus involve correspondence with clients that might go outside of routine activities when performing attest services. We're here today to tell members that they really need to be cautious of crossing the line that may lead to providing prohibited non-attest services. So Jeff, let's first talk about the applicable independence rules and how much assistance as a non-attest service a practitioner could provide to its attest client. Under AICPA standards, what rules should be considered?
So when you look at the AICPA standards and you're looking at the Code of Professional Conduct, the non-attest standards or the non-attest rules exist in section 1.295 of the code. I would say the overarching principle that's in there in the code with respect to non-attest services is that management at the client has to assume all management responsibilities. Now, another way to say that is that the member cannot take on any of those management responsibilities. Now, in accomplishing that, what the client needs to do is have one person or some people that are designated to oversee the services that the member is providing. They have to evaluate the adequacy of those procedures, accept responsibility for the results of the services, and they have to accept responsibility for making all significant judgments and decisions related to those services. Now, having said all that, just keep in mind that we're talking about the AICPA rules. The member needs to also consider any state board rules that might be more restrictive or any standards that could be applying to the attest engagement that they're performing that's in addition to the AICPA standards. So things like DOL standards or government auditing standards or even the SEC rules if they apply.
Makes sense. And I think the key concept there is when providing these non-attest services, not to cross that line into management responsibilities. As Jeff, you mentioned designating somebody to oversee the services, somebody with suitable skills, knowledge, and experience to oversee the services. In order to be independent, though, what does the code say about management responsibilities?
Yeah, so the code lists a long list of what could be considered management responsibilities, types of activities. Rather than going through all of those, I would just mention a few that are probably more relevant to this topic. One is just leading and directing the entity. I think about project management when I think of that. So the member should not take on the responsibility of leading the project with respect to ASC 606. The client still has to lead that project. The client still needs to make those significant business decisions with respect to the revenue recognition project, setting policy and strategic direction. Preparing source documents would be considered a management responsibility. So the member should avoid situations where he or she might be preparing source documents that evidence a transaction's occurrence. And then reporting to those charged with governance. Now, the member can attend those types of meetings to help answer questions, but should not be reporting on behalf of management. Management needs to accept that responsibility in that role.
So as it relates to the revenue recognition standard, really the client needs to understand that standard. So when we talk about management responsibilities, understanding the new standard, skills, knowledge, and experience, what should auditors look at when they're evaluating SCI?
Yeah, so when they're evaluating the skills, knowledge, and experience of those that are designated to oversee the services, you're going to look at what's their knowledge of the operations of the company, and what's especially the subject matter, which in this case is revenue recognition, which can incorporate pretty much almost all the activities of the entity. What's their experience and knowledge over that subject matter, both at the company and maybe prior to being at the company? Just how long have they been in that position to where they can demonstrate their knowledge of that subject matter?
So now let's talk about threats to independence. What threats, and this is kind of taking it back to the basics so that we can make sure that we're clear, what threats can be present when a member performs non-attest services?
Okay, so the code will list out 7 different types of threats. And with respect, again, instead of reading through all those or going through all those, I would mention probably three primary ones. The first, again, management participation. We've mentioned that several times, so I won't belabor that one. Also, the self-review threat. I think that's the biggest one other than management participation. Obviously, you cannot perform attest services over your own work. So if we're talking about an audit as the attest service, you can't audit your own work. I think we're all pretty familiar with that. And then another one that may be applicable is the advocacy threat. So management may want to get a certain answer, and then we're looked at as trying to promote that result or trying to obtain that result rather than just getting the result that would come through applying the standard the way it should be.
So we've got to look at those possibilities and evaluate those threats. And when we do that, can they be at an acceptable level where we can do those non-attest services for the attest client?
Well, it could. You can apply safeguards is the way the code would direct us. So you can think of certain safeguards that apply to the non-attest service so that you can still reduce that threat to an acceptable level. One thing you might be able to do is ensure that the attest team and the non-attest team are completely different individuals.
Okay.
Another thing you can do is have someone who's unrelated to either service do a review of the work, whether it's a review of the work of just the attest work or both services, just someone that's completely disregarded from both engagements. I just think you got to be careful though and remember that we're talking about a pervasive part of the financial statements, and if those threats could be at such a level that you just can't provide enough safeguards to reduce that. So just keep that in mind. And I think you also have to look at the cumulative effect.
Right.
You know, what's the cumulative effect of doing any other non-attest services that you're performing at the client? And at some point, you're doing so many, you could bring in another one of the threats, the familiarity threat.
Right.
And so that's another one to consider.
Absolutely. And what's the time frame to consider when these services are provided?
Yeah, so there's really 2 periods of time. And one would be the period of the attest professional engagement. And that starts when you either sign the engagement letter for the attest engagement or you start performing those attest services, whichever comes sooner. And that period lasts until you formally terminate performing that attest relationship. So as an example, if you were performing an audit of the 2018 financial statements and you completed that in 2019, let's say you issued the opinion, you completed that attest relationship or that attest engagement in March of 2019, that doesn't mean you can then go do a prohibited non-attest service in June of 2019 because your attest relationship hasn't really ended because you may still be engaged to do the next year. So unless you formally say we're no longer going to perform attest engagements, then you're still continuing that attest relationship. So that's one period of time you have to consider. The other period of time is just the period covered by the financial statements that you're going to perform the attest engagement over.
Okay, so really make sure that you understand the time frame and evaluate those threats.
Right, for both those periods of time.
Exactly. So routine assistance, it's okay to do that. And, as I mentioned at the beginning, we've got members that are going to have clients that are going to need help with the standard. So when a member assists the attest client with planning and executing the implementation of a new accounting standard, such as the new revenue recognition standard, what are some things to consider and what should members be aware of?
Yeah, so I mentioned already about the pervasiveness of the service with respect to revenue recognition. This is, for most clients, I would think, is the most significant class of transactions that they're going to have. So because of that pervasiveness, we got to be careful. It's not like doing depreciation schedules for a client or a LIFO calculation. This is much more involved. It has effects throughout the financial statement. So because of that, we have to be more careful, I think, of what services we're going to be providing and helping with respect to that recognition. In connection with that, this standard it's a principles-based standard, so it requires more judgment. I think the standard also requires more estimates that are going to be made, and estimates, again, bring more judgment. There's policy decisions that have to be made on how you're going to apply the standard. So all of those get back to management responsibilities, and the member just needs to be careful that you're not overstepping and starting to perform those types of judgments, policy decisions, and management responsibilities. And then obviously scope creep is just another one. As you get into the project, you may decide that what you're providing and the help you're providing is acceptable, but then the client realizes, hey, we need more help with this area of the project or this other area of the project, and you can quickly find yourself doing too much work, and then all of a sudden now you've gone over that line and you're no longer independent.
Right. And I think you mentioned earlier too that auditors are going to need documentation from the client that support the conclusions they reached about how revenue should have been recognized for the contracts being tested. And I think that's what makes this standard a little bit different, as Jeff mentioned, a little bit more involved, and in the area of more management responsibilities that the member needs to be cognizant of and make sure that they don't cross that line, as Jeff mentioned. Just want to mention a couple of reminders about accounting auditing estimates. The auditor is required to determine whether management has appropriately applied the applicable financial reporting framework, which FASB ASC 606, like we're talking about today, and the methods for making those estimates, whether that's appropriate, whether changes from prior periods might be needed in certain circumstances. And I think the pressure is going to be on, because if the client hasn't undertaken or hasn't,
if they've waited this long,
and can't document compliance with the new standard, then how is that auditor going to obtain sufficient audit evidence?
Right.
So Jeff, what can the audit firm do to assist?
So I think it's not, all hope is lost, though I think we can help our clients. One of the things we can do is be a sounding board for them. We can attend the meetings, their project meetings. Again, we can't manage or can't lead that meeting, I wouldn't think, and we certainly can't lead the project as we mentioned before. But attending those meetings to act as a sounding board, providing links to where guidance can be found or where in the standards they can find answers to some of their questions. We can assist with gathering information for the client. Now, again, the client's going to decide what information needs to be gathered, but then we can help them gather that and accumulate it for them. And then overall, just providing advice with respect to best practices and maybe give them some ideas of implementation tools that they can go and get and use.
Sure. Well, Jeff, thanks for being with me today. And auditors, please take time to look at the free resources that we have to assist with accounting estimates. And they can be found at aicpa.org/revenue recognition. And these include an implementation plan roadmap, a roadmap to understanding the new revenue recognition standards, as well as accounting and auditing guides and webcasts. And thanks for joining us today.
This podcast is designed to provide illustrative information with respect to the subject matter covered and does not represent an official opinion or position of the AICPA or AICPA.org. It is provided with the understanding that the AICPA and AICPA.org are not engaged in offering legal, accounting, or other professional service. If such advice or expert assistance is required, the services of a competent professional person should be sought. The AICPA and AICPA.org make no representations, warranties, or guarantees as to, and assume no responsibility for, the content or application of the material contained herein, and especially disclaim all liability for any damages arising out of the use of, reference to, or reliance on such material.